The American economy currently functions at peak performance, combining market size, industrial productivity, and geopolitical reach in a way that no other country matches. Yet this strength is shadowed by a national debt that recently crossed $39 trillion. Splitting that debt between every man, woman, and child in the country leaves each individual with a $116,000 share. While the raw size of that principal is significant, the immediate risk lies in the specific cost of maintaining those loans. This chart illustrates the rising cost. In 2020, annual interest expense was $523 billion. By 2025, it reaches $1.22 trillion. Mapped against other priorities, interest exceeds the entire national defense budget, dwarfing education and social services. The government is now obligated to divert over $1 trillion annually to debt service, capital that cannot be used for infrastructure or economic growth. This raises a central question. How did the United States operate at a deficit? It must fund its annual spending by issuing millions of smaller loans to global investors. These are known as treasury bonds. Many of the bonds issued during 2020 locked in historically low interest rates. For several years, these loans were exceptionally cheap for the government to maintain, but old bonds expire. Lacking cash for the principal, the government refinances by issuing new bonds. These new bonds use today's higher rates. Transitioning from near 0 to 4% physically bloats the payment needed to service that same debt. Simply rolling over existing debt in a high-rate environment forces the total interest bill to climb, even if the government doesn't spend a single new dollar on public services. This raises the question of why the Federal Reserve does not lower interest rates to ease this specific refinancing burden. The barrier is cost-push inflation. When supply chains break down, the Fed must maintain high interest rates to keep prices from spiraling. Geopolitical instability provides a clear example. If shipping lanes in the Strait of Hormuz are blocked, global oil prices spike, which increases the cost of domestic manufacturing and transportation. While global events keep interest rates elevated, domestic fiscal policy is simultaneously increasing the total amount of debt that must be serviced. This graphic shows the impact of recent legislative proposals. By tilting the scale with $4.5 trillion in lost revenue against only $1.4 trillion in spending cuts, the policy adds a net $3.4 trillion to the deficit over a decade. Geopolitics trap interest rates at high levels, while domestic tax policy adds trillions to the principal. The result is a cycle of borrowing more money at increasingly expensive rates. This creates a debt spiral, where a government borrows new money just to pay interest on old debt. As it accelerates, this debt becomes a structural constraint, requiring so much capital it limits the ability to fund other operations. Reversing this trend generally requires one of three mathematical solutions: raising taxes, cutting spending, or achieving economic growth that outpaces the debt. Cutting spending is difficult because the majority of outlays go toward programs like Medicare and Social Security, which millions of citizens rely on for basic survival. With taxes resisted and spending cuts deemed politically hazardous, the interest costs are now competing with the very growth needed to escape the cycle. This situation points to a systemic paralysis within Congress, which appears incapable of legislating the fiscal discipline required to stabilize the balance sheet. Budget leaders are now characterizing these mathematical trends as an existential threat to the nation's future stability. The severity of the problem has led to calls for an Article 5 convention, an attempt to bypass Washington entirely and rewrite constitutional rules to enforce fiscal restraint. Attempting to print $39 trillion as a solution would trigger massive inflation, devaluing the dollar and effectively taxing citizens through the loss of their purchasing power. The inescapable compounding mathematics of the national balance sheet now poses a risk to American supremacy as potent as any external conflict.